Hey everyone, welcome back to our channel Framing the Tech Minds. In today's video, we'll understand one of the most important chapters in business studies, financial markets. From money market to capital market, from stock exchange to SEBI, we'll simplify everything you need for your board exams and real-life understanding. So, grab your notebook and let's dive in. In part 1, we will understand what is a financial market. Every business needs money to buy machines, pay salaries, or expand operations. But where does this money come from? That's where financial markets play a key role. A financial market is a place where people who have surplus money, called savers, meet those who need money, called investors or businesses. It helps in mobilizing savings and channelizing funds into the most productive uses. So, in short, financial markets act as a bridge between savings and investments. Now, let's discuss functions of financial market. The financial market performs 4 key functions. 1. Mobilization of savings. It transfers money from savers to businesses. 2. Price discovery. It helps decide the price of financial assets through demand and supply. 3. Liquidity. It allows investors to sell their assets anytime and convert them into cash. 4. Reducing transaction costs. It provides a common platform for buyers and sellers, saving time and effort. Classification of financial market. Financial markets are mainly divided into 2 parts. Money market for short-term funds, less than 1 year. Capital market for long-term funds, more than 1 year. Let's understand both one by one. What is money market? The money market deals with short-term borrowing and lending. It helps in managing day-to-day cash needs of businesses and governments. Main participants: Times Reserve Bank of India, Times Commercial Banks, Times Non-Banking Finance Companies, NBFCs, Times Mutual Funds and large corporates. Main instruments: Treasury bills, T-bills, short-term government securities with maturity less than 1 year. Commercial paper, unsecured promissory note issued by large companies. Call money, short-term loans between banks for 1 day to 14 days. Certificates of deposit, issued by banks to raise large sums of money. Commercial bills, bills drawn by one trader on another to finance trade transactions. The money market helps maintain liquidity and short-term financial stability. Now, we will cover about capital market. The capital market deals with long-term funds. It includes arrangements through which businesses and governments raise capital for more than 1 year. It is divided into 1. Primary market, new issue market, where new securities are issued for the first time. 2. Secondary market, stock market, where existing securities are bought and sold. Capital markets encourage savings, investment, and overall economic development. Okay, now we will see difference between money market and capital market. Capital markets and the money markets are key components of fundraising in the economy. Here is how these 2 markets differ from each other. The money market is for raising short-term funds and also for deploying, lending, short-term funds. Governments, banks, NBFCs and corporates regularly access the money markets to raise funds for the short term, while corporates and banks are more active users of the long-term capital markets. Money markets come under the purview of RBI monitoring and regulation, while the capital market regulations come under the purview of SEBI. However, the RBI also gets involved in capital market regulation if it involves public debt or currencies. Similarly, the IDI is an interested regulator if the subject is an insurance company. From an investment perspective, money markets are to deploy short-term surpluses, while capital markets are for long-term wealth creation. The money market, being largely an institutional market, is monitored but not too strictly regulated, an organized money market. However, the capital markets are more comprehensively regulated as there are retail investors and market integrity involved. Capital market is more exchange-driven regulation, while money markets, being OTC, are less regulated. What are the popular instruments in the money markets? It includes certificates of deposit, CD, commercial paper, CP, treasury bills, call money repos, etc. The capital market instruments includes equity, bonds, and convertibles, hybrids of equity and debt. Let us look at tenure, liquidity, and risk. The typical tenure of money market instruments ranges from 1 day to 1 year. Capital markets are for the very long term, and at times to perpetuity. Money markets are more liquid and offer easy entry and exit to players. Hence, due to the higher liquidity and lower tenure, money markets tend to be less risky. Who are the major participants? In money markets, the major participants are the government, banks, insurance companies, financial institutions, primary dealers, PDS, etc. In capital markets, the key players are retail investors, mutual funds, FPIs, HNIs, brokers, stock exchanges, depository participants, etc. Finally, what about returns? Obviously, returns on capital markets are higher considering the higher risk quotient. Money market instruments are more consistent and predictable, albeit with lower returns, which is why short-term liquid funds can be safely parked in money market instruments. Stock exchange. A stock exchange is an organized marketplace where existing securities are traded. The famous ones in India are BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. Functions of stock exchange. Provides liquidity and marketability to existing securities. Helps in price determination through demand and supply. Ensures safety of transactions under SEBI regulations. Contributes to economic growth by encouraging investments. Spreads equity culture and provides a platform for speculation in a controlled manner. Modern stock trading is fully electronic, done through online platforms and demat accounts. Next, what is online trading and dematerialization? Earlier, traders used to shout and buy shares on the trading floor, but now everything is online. You can buy or sell shares with just a few clicks. You need a demat account to hold shares electronically, a trading account with a broker, a bank account for money transactions. All settlements happen in T+2 days, meaning within 2 working days. This system is safe, paperless, and transparent. In next part, we will go through about SEBI, the regulator. The Securities and Exchange Board of India, SEBI, is the regulator of our capital market. It was set up in 1988 and became a statutory body in 1992. Objectives of SEBI: protect investor interests, regulate stock exchanges and brokers, prevent unfair trading practices, promote fair and transparent dealings. Functions of SEBI: regulatory, registration, supervision, and regulation of market intermediaries. Developmental, training and development of market participants. Protective, prevention of insider trading and price manipulation. SEBI ensures that every investor gets a fair deal in the market. Finally, we will go through for recap and conclusion. So let's quickly recap what we learned today. Financial markets link savers and investors. Money market short-term funds. Capital market long-term funds, primary plus secondary. Stock exchange platform for buying and selling securities. SCBI protects investors and regulates the market. And that's all about financial markets. If this video helped you understand the topic better, don't forget to like, share, and subscribe to our channel Framing the Tech Minds for more such CBSE Class 12 Business Studies videos. Comment below which chapter you want next. And remember, smart studying always beats hard cramming.